Greetings, Keith Prather here with NCM, and I have the Marine Economic Outlook. So the index for this month, the Marine Demand Index, was actually giving us some really strong signals. And again, this works a little bit like a leading economic index where it's giving us an idea of what the demand environment is going to look like over the next 6 months. And based on the latest data, and this index has a number of different economic factors that blend into it and drive it. And based on this latest index, it's giving us a really good signal for 2025. So the January index came in at 104.2, which is up from December by about 0.4%, which is good. It was about 17% higher year over year. So really strong signal versus last year. Now last year, the only little caveat we have is that we were coming into basically a trough. And that trough, we had weaker spending coming into early last year. So we're going up against an easy comparative data point. But that growth rate right there is actually pretty significant. We talk about 17% higher. So, I mean, if you're a dealer and you're setting budgets and you're looking at spending, I mean, you're feeling pretty good about at least some of what you saw in January. And this is not going to be nationwide, right? There's going to be pockets of growth and really good pockets of sales, and sales expectations are going to be high in some areas and they're going to be lagging in others. And we'll talk about some of the concerns coming up that we're really watching. But again, at least from the leading index perspective, we got some pretty good signals this month. The producer price index, again, this is just a little bit on what we're seeing for overall cost of building and what we're seeing from a demand and demand and supply perspective. So it was unchanged month over month, just 1.4% higher year over year, but it's still pretty sluggish overall. So that may mean that what you're seeing is a little bit of pricing pressure in the boating industry. And in fact, I mean, we did see that in some of the other data, and we'll talk about that in a minute. But the producer price index for boat building, still remaining fairly sluggish, especially against that long-term trend where we'd like to see it a little bit higher. So this is a trend that I'm talking about this month across all the videos, and this is so important, I think, for the overall industry and what we see sales like, especially at a consumer level. So several things here. This is looking at GDP coming into Q1, and coming into Q1, we still see the growth rate about 2.3%, whether it's the actual GDP now estimate, which is kind of a running tally of GDP, or whether it's the blue chip consensus estimate. So this is 100 of the top economists, and they create a range of, the different forecasts. And so blue chip consensus is about the same right now, 2.3%. In perspective, then, that would mean 2025 is still running hotter than what we saw last year at about 1.3%. Now, again, that's macroeconomic view. That's the top level, highest level of spending. Now, the interesting thing is that consumer spending was driving about 82% of GDP coming into the end of last year, so in the fourth quarter. That normally should be about 73%. So consumer spending, number one, is actually doing very, very well, very strong, which is fantastic. But the big thing I wanted to show you here is that economically, we're going through a cycle where we're trying to transition the U.S. economy from what is a heavier government spending driven growth rate. Government spending in fourth quarter was 18% of GDP, which is way too high. Normally should be somewhere around 12 to 13%. And this government spending figure does not include things like Medicare, Medicaid, or Social Security. This is just government overhead, government spending on facilities and offices, and just the spending that's administrative spending. So it's way too high. And that's what the Trump administration is really focused on, is cutting that spending. Again, they're looking for $1 trillion in cuts. Don't know that they'll get there, but they're also looking to trim about 250,000 government workers, out of about 2.5 million. Doesn't include the military. So that's the big impact. And as they really build momentum early, they want to get all these cuts in the first half of the year as much as they can. That's going to lead to some softening in spending overall. But what they're trying to do is transition that down into the private sector. So they want individuals and corporations deciding how they want to spend their money. So they're reducing regulation, they're speeding up the permitting processes, they're creating incentives for companies that want to build manufacturing facilities or want to increase construction activity of all types. invest in automation, invest in robotics, invest in all kinds of different technologies, and to create jobs in the process. So that conversion and then easing up conditions like interest rates and borrowing costs for home buying or refinancing homes, that's a lot of the focus of the administration in the front end. But it's that transition between this heavy government spending component and then trying to boost the residential and the non-residential side of the world. So the private consumer and what happens at the corporate level. That transition is kind of the period we're in right now. And it can be chunky, it can be sluggish, it can be a little chaotic. And that's kind of what we're going through. And that's why you saw consumer sentiment dive a little bit just in the latest metrics. But a lot of that will pop back up. It's a transition period, and we've got to go through that transition period. And what the market needs to see is that transition and stronger growth rates down here. That's also why when you hear like Apple Computer, right? Apple promising to invest $500 billion into the United States over the next several years. That's why the Trump administration is pushing that information so hard because they want proof points that that transition is happening and that that spending is coming. So that's kind of where we are. Specifically for the industry, then a couple of things. So we know that tariffs are a big deal, and we know that Trump has applied Trump Trump tariffs specifically to aluminum and steel. And aluminum boat sales are some of the best boat generated sales or marine sales overall in the industry. And we know that aluminum tariffs are going to increase the price of those boats. And that's a concern. Depending on how it gets applied and depending on what kinds of exclusions the Trump administration offers, this could be a big factor in 2025. And I know everyone's talking about it. And I know all the dealers are talking about it. Just to put some context around the tariff issue, and I've talked about it before, but in 2018 and 2019, the Trump administration issued about 18,000 exclusions to tariffs. Now, he has singled out aluminum as an area where he believes that US production can meet demand or improve demand. And so he's increasing tariffs on aluminum imports from around the world. Now, I believe when push comes to shove, the industry will push back enough. This industry, plus many, many others, are impacted heavily by aluminum costs. And I think you'll see the administration not buckle, but I think they'll ease off a little bit. The other thing that we're watching is the impact of currency exchange rates. So let me give you an example. So let's assume a product is $100 and we're importing it from China, and China got hit with another 10% tariffs. That item at $100 with a 10% tariff becomes $110. But what China does is, and what they did in the first round of tariffs is they devalued their currency by 10%. So that new $100 item after the devaluation of the currency suddenly becomes a $90 item. And then when you apply the tariff, the net effective tariff rate that you pay is about $99, actually a dollar cheaper than prior to the tariff being applied. Now, there's a lot of impacts. There's a lot of things that happen to those countries when they devalue the currency. Inflation in those countries go up. So the product that you're buying for $100 or after the exchange rate at $90, the input costs for that actually start to go up. They import products, their currency doesn't buy as much, and so it pushes inflation up. It's also more expensive for them to finance their government debt. So there's a lot of repercussions that come along with that that kind of get factored into the mix. But essentially, what I'm trying to tell you is that 25% aluminum tariffs look scary on the surface, but when you look at the actual applied amount, the actual effective rate, they're going to be south of that somewhere. We don't know how far south, but they're not going to be at that full 25%. So your input costs or your cost of building an aluminum boat or selling an aluminum boat isn't just automatically going to go up 25%. And I guess that's kind of the bottom line. So I see as I go out and do research, I see a lot of focus on sustainability and hybrids and a lot of that. And it's actually still an important part of the market. The hybrid market in the powerboat industry is a little bit higher than it is than what we see in like automotive and maybe some of the power sports categories. But 64, almost 65% of powerboat sales are still internal combustion engine units. So So we still got to watch that. But there's a growing percentage of hybrids out there. The big thing is value-based buyers. We know that the value-based buyer is going to be the key to volume this next year. And they're becoming even, we thought they were value-based in 2024, but they may even become a little more value-based in 2025, depending on what happens with tariffs and the impact on inflation. So 14% growth in boat sales are expected for those boats under $40,000, we're expecting a 14% growth rate. Sorry. And first buyers are going to account for about 38% of those sales. So that's a strong, healthy growth rate, but for boats in a certain price category, right? That shouldn't be a surprise to us. I know we were already seeing this trend last year, but we're actually going to expect to see some acceleration in buyers in those cheaper price points. Pontoon sales under $50,000 are stabilizing. We know they had a rough year in 2024, and now we're seeing projections of growth maybe as high as 6% in 2025, as long as labor conditions hold where they are. We don't know what that ripple effect will be if we do indeed find 250,000 government workers transitioning out. A lot of them are going to get such sufficient buyouts, and a lot of them are close to retirement. What you may actually see is a lot of government workers that are transitioning out suddenly having time on their hands, and they decide to go out and buy a boat. And that could happen. And so we're expecting maybe a little bit of a lift from some of that instead of the doom and gloom and economic, detractor from it. PWC still selling well on coastal regions, and we saw an uptick at the end of last year. Still a little bit of sluggishness in fresh water, but that's all expected to improve. And again, we're watching the consumer sentiment in this transition period and really what happens with it. So overall, we've got some deflecting or some conflicting data, but GDP last year grew about 2.7%. This year, the Federal Reserve believes it's going to grow at about 2.1%. Now, the Trump administration, the brand new Treasury Secretary Scott Bessent believes he can get about 3% out of the economy. And I think the transition period that we talked so much about early on is going a little bit worse than expected. So I have a feeling we're going to be a little bit south of 3%, but another 2.7% or somewhere between 2.5 and 2.7 is entirely possible this year. And then we settle back down into that long-term 2% growth rate. Now, Scott Bessent believes that 3% growth in 25 is also possible in 26, 27, and 28, even keeping inflation under control. So it's a difficult task. See if he can pull it off. It'd be fantastic if he does. It'll be almost historic if he does. So employment rate expected to inch up just a little bit this year in 25. A lot of that, again, is surrounding kind of what's happening with the government workers and trimming of government workforce. Inflation fairly flat and then decelerating in 26 and 27. And then the Fed funds rate, we're still expecting, again, another 50 basis points in cuts in 2025, and then another 50 maybe in 2026. So for boats, it's interesting. The Fed funds rate is typically short-term borrowing. So some of the lower end boat prices, those probably will be impacted by what the Fed does. A lot of other boats with a lot of longer terms, when you get 7, 8, 9, 10-year terms, a lot of those are going to be affected more by the U.S. 10-year Treasury rate, which has been a little bit higher recently. Again, the Treasury Secretary understands this, and he's working on pushing that Treasury rate down. So whether you're looking at the Fed funds rate from the Federal Reserve or the Treasury rate, we expect by this summer that all those interest rates are going to be coming down, and that should loosen up the boating and the marine industry a little bit and kind of help out with luring those value buyers back into the market and then keeping the upper end buyers still interested and still engaged. So, all right, there's a lot there, and there's a lot of moving parts still. But we'll pick it up next month, and hopefully we'll have a lot more clarity on what's really happening, especially with tariffs, what the impacts will be, what kind of exclusions we get, and we'll kind of take it from there. So, hope you all have a very safe month, and we'll see you next month. All right, take care. Bye bye.